It is no secret that the California housing market has dealt with its fair share of challenges this year, with home values coming in at $746,000, many insurance providers actually leaving the state. Those that are staying are actually set to see major rate hikes moving into 2024, while mortgage rates hover at near 2-decade highs. It's no wonder why we're dealing with severe affordability challenges. So in today's video, I'm going to break down how much it takes to buy a home in California. Not just the out-of-pocket costs that are incurred, but also the income needed to qualify. But before we jump into it, if I could ask a small favor, press that like button, consider subscribing. It helps grow and promote the channel, and I do appreciate your support. All right, the first thing that we want to do is talk about the costs involved in purchasing a home in California. Now, while this may apply to everywhere throughout the United States, we're going to specifically talk about the California market. There are two major costs involved. The first is down payment. The second is closing costs. We're going to review each one individually, starting with down payment. Now, your down payment is essentially your skin in the game. This can range depending on your loan product, anything from 0 all the way up to as much as you feel financially comfortable putting down. And it's essentially the equity that you have in the home. It's the difference between what you owe, your loan amount, versus what the property is actually valued at the time of purchase. According to National Association of Realtors, across all age groups, the median down payment is coming in at 14%. But for purposes of discussion here, let's take a look at those that are entering their prime buying age, which is going to be the millennial cohort. Anyone ages 32 to 41, their median down payment is coming in at about 11%. But to simplify things, let's just round down. Let's say the median down payment is coming in at 10%. If we use the average home value of $746,000 and we calculate a 10% down payment, that would mean the out-of-pocket expense there for the down payment alone would be $74,600. Now, as I mentioned, this is not the only out-of-pocket expense. The second cost involved would be closing costs. And these are essentially the one-time fees that are associated with the actual transaction. This right here is an example of a loan estimate, and it is essentially a detailed cost breakdown of all of the fees that are involved in a transaction when you're securing financing. Starting with box A, you're going to have origination charges. And if you're out there shopping for a mortgage, you really want to hone in on box A because these are specifically the lender charges, things like discount points, origination charges, application fees, underwriting fees, things of that nature. When you're comparing with other lenders out there, you want to not only look at the rate, but you also want to look at the cost involved in securing that rate. Box B is going to be the services that you cannot shop for. These are things like third-party fees, appraisal, credit report, flood determination, tax monitoring fees. Box C is going to be the services that you technically can shop for. It's going to be like your title and escrow. So the lender's title policy, the settlement agent fee, escrow closing fee, pest inspection, survey fees. Now, even though you do have the ability to shop for these expenses, it's not uncommon in California for the listing agent or the seller to pre-open with a specific title company. So just be aware of that. You can negotiate it into the contract if you so choose. Box E is going to be taxes and other government fees. These are things like that are charged by the county or the state. They're recording fees, they're other taxes, they're transfer taxes. Box F is going to be your prepaids. So this is typically going to be anything that's required to be paid upfront. So a lot of times what happens is you have to prepay the annual homeowners insurance policy, any taxes that are due, and then any interest that's due prior to the first month's payment on a prorated basis. That would be found here in box F. Box G is the initial escrow payment at closing. Should you choose to escrow your taxes and insurance, which is essentially an account held by the lender, they manage your tax and insurance payments. And each month that you make a monthly payment, the lender retains that money in an escrow account. So when those bills are due, they have the ability to cut the check. Box H will be any other costs. These would be things like owner's title insurance policy, maybe a home warranty. You might find that here. And then box J is going to be your total closing cost. With that said, the average closing costs on a home in California, according to Bankrate, are coming in just under about $8,000. But I can tell you from experience that it's much safer to budget for a range. What I did is I broke down a range anywhere from about $8,000 to $12,000. This is going to be highly dependent on the costs associated with taxes, insurance, and lender fees. But if we were to just use a good round number, we'll go right in the middle here and we'll say the estimated closing costs are going to be about $10,000. So if we take into account the down payment at just under $75,000, we factor in the closing costs, we're going to have a total out-of-pocket expense at $84,600. Now let's go ahead and break down the housing expenses in California, starting with number one, which is the mortgage. And if we take into account the scenario that we just worked out, $746,000 purchase price, 10% down payment, we would have a loan amount at $671,400. Assuming we'd qualify for the average 30-year fixed mortgage rate today at 6.77%, we'd be looking at a monthly principal and interest payment of $43.63 per month. This would be fully amortized, a 30-year fixed rate mortgage, meaning we'd pay a portion to interest each month and a portion to principal, and over long periods of time, the value of the loan balance would actually go down. The second expense that we would incur would be property tax. And according to Smart Asset, a good rule of thumb for California homebuyers who are trying to estimate what their property taxes will be is to multiply their home's purchase price by 1.25%. This incorporates the base rate of 1%, which is of the purchase price of the property, plus any additional local taxes, which generally work out to about 0.25%. If we take the purchase price of $746,000, we multiply by 1.25%, we would have annual property taxes sitting at $9,325, which works out to about $777 per month. The third expense that we need to account for is going to be homeowners insurance. And according to Policy Genius, the average cost for homeowners insurance in California is $1,383 per year, or roughly $115 per month. But that is for a policy that provides us with about $300,000 in dwelling coverage. Now, given the purchase price that we're looking at, we know that $300,000 in dwelling coverage is probably not going to be enough to actually rebuild that structure. So let's kick it up a little bit and just assume that the dwelling coverage that we're going to need is going to be somewhere around $400,000 with an average annual cost of about $1,773. But at the same time, it is important to realize that homeowners insurance in California is going up dramatically. In fact, one of California's largest home insurers, State Farm, is actually planning to raise rates by 20% in March of 2024. So these costs could continue to rise. If we just assume that the average homeowner's insurance will work out to about $1,800 per year, that would give us a monthly payment for insurance at $150. And then we need to account for item number 4, which is private mortgage insurance, or PMI. Private mortgage insurance is a type of mortgage insurance that you might be required to buy if you take out a conventional loan with a down payment of less than 20%. And in this example, we're putting 10% down, so we'd be required to carry PMI. Now, PMI is generally calculated by a variety of factors. They take into account home price, down payment, interest rate, credit score, and even the debt to income ratio. And according to the Urban Institute of Housing Finance Policy Center, for those with excellent credit, the average annual PMI premium is going to land right at about 0.46% per year. With that said, if you're in a position where you have excellent credit and your debt ratio is under 40%, you do have the ability to shop around from lender to lender. And I have seen PMI premiums substantially lower than this 0.46%. If we were to just assume that you qualify for the lowest mortgage insurance premium that is out there, you could see an annual premium coming in at about 0.25%. So if you multiply that by a loan amount of $671,400, that would give you an annual PMI payment of $1,678, which works out to about $140 per month. And then the fifth housing expense that we need to discuss is the HOA, or homeowners association fees. Now, this doesn't necessarily apply to every home, but it's worth noting here in this video. Now, a homeowners association is essentially an organization that makes and enforces rules and guidelines for a subdivision, a planned community, or a condominium building. Homeowners associations are ran by a board of directors, and they typically collect a monthly or an annual fee, and those funds are utilized to pay for common area maintenance. So a lot of times that will include things like road maintenance, upkeep and maintenance of facilities, things like a clubhouse or a common area pool. And every once in a while, they'll actually handle front yard maintenance, just depending on the actual HOA. The homeowners associations basically are the ones regulating the communities and upholding all of the rules and guidelines. So in some cases, homeowners associations may actually impose fines for non-compliant homeowners. And this is essentially done to maintain specific standards throughout the community. In this example, let's just assume that we don't have an HOA that we have to deal with. So let's tally up all of the actual expenses here, your principal and interest payment, property taxes, insurance, PMI. That would give us a total monthly payment coming in at $5,430 per month. Oh, but wait, that's not the only expense involved in purchasing a home. And as the old saying goes, while rent may be the maximum amount that you pay out of pocket, your mortgage is actually the minimum amount out of pocket. And according to Wells Fargo, they actually recommend setting aside 1 to 2% of the purchase price of your home each year for routine maintenance projects such as roofing repairs, sewer updates, or new appliances, each of which can cost several $1,000s. Now, if you consider the purchase price we're talking about here at $746,000, 1% of that would be about $7,500 a year. 2% is nearly 15 grand. If we were to set aside $15,000 a year for routine maintenance and capital expenditures, we're looking at another $1,250 per month on top of the monthly mortgage payment, which of course is one of the expenses that many first-time homebuyers never actually account for. All right, shifting gears here, how much can we actually afford? Or said another way, what amount of income will it take to purchase a $746,000 home with 10% down, assuming the monthly payment will land right at about $5,430 per month? Well, lenders, they're going to use something that they call the debt to income ratio. And this is essentially how they determine how you qualify for the mortgage. As a general rule of thumb, lenders will use a 45% DTI or debt ratio. This is essentially the percentage of your gross monthly income that goes to paying your monthly debt payments, and it's used by lenders to determine your borrowing risk. The higher the debt to income ratio, the more risk associated with the borrower. The lower the DTI, the lower amount of risk. As an example, if we have $10,000 in gross monthly income and we go to the max debt to income ratio at 45%, then our monthly expenses cannot exceed $4,500 per month. That's housing and additional costs or liabilities that would show up on a credit report, things like credit cards, car payments, student loans. So in our example, we'd have a mortgage payment of $5,430. If we divide that by the debt ratio of 0.45, we would need a monthly income of $12,066, which works out to about $144,800 on an annual basis. But this is assuming that the home buyer has no other debts, which really isn't always all that common. In fact, if we're looking at the millennial cohort here, according to CNBC, they have roughly $27,251 in non-mortgage consumer debt on average. If we assume a 2% debt service, that would mean that the monthly payment on that debt would roughly come out to about $545 per month. If we just look at a monthly breakdown of those debts, we would have the housing payment that we need to account for. Let's assume there's an auto loan in there at about $300 per month, student loans totaling $195, and maybe $50 a month in credit card debt. That would give us total liabilities of $5,975. If we use the same calculation for the debt to income ratio, a lender would actually require a monthly income at $13,277 or about $159,333 annually in order to qualify for that home purchase. After reviewing all of the numbers there, it's no wonder California is dealing with affordability challenges in their housing market. My thought is this: it's very expensive to buy in California, but it's also very expensive to purchase in many markets across the United States. So rather than timing the market, we need to make sure that when we purchase, it makes financial sense for us. Personal finance is personal. And while that may be different for everyone or every couple, a few things that you may want to consider. Number one is that you have enough money saved to cover not only the down payment, the closing costs, and the expenses that you're going to incur while you're moving, but also you'll be able to maintain at least a 3 to 6 month emergency fund for anything else that may come up when you initially purchase and over the first year or two of owning that property. Number two is that you're gainfully employed in a stable industry, which is to say that your income will remain steady and hopefully increase moving into the future. And preferably on the income note, you'll want to make sure that your debt ratio is well under the 45% threshold that lenders will actually allow, just so that it will provide you with a little bit more breathing room when it comes to making those monthly payments. And third, have a long-term time horizon when it comes to purchasing a home. Who knows what's actually going to happen to home prices here in the next 2 or 3 years? We really cannot predict with any real level of certainty. They could go up, they could go down. The last thing that you want to do is get stuck in a property, having negative equity and not being able to sell or having to cut a check to sell. Because you got to remember, the cost to exit a property is generally going to be 5 to 6% when you account for commissions and closing costs associated with that transaction. But if, let's say, the average home appreciation in California is around 5% per year, the longer amount of time that you can hold a property, I like to look out 10 plus years, it will increase the probability that the home will become a profitable investment. And that is going to wrap it up for today's video. If you got any value out of this, please press that like button. Consider subscribing. It helps grow and promote the channel, and I appreciate your support. Thank you so much. Happy New Year. Take care.